What's better than earning money from a 9-to-5 job? It's earning money while you sleep, which is made possible if you start investing. You're listening to the Real Estate Investing Demystified with your very own dynamic duo, Ava Benasaki and August Biniaz. Tune in as we discuss everything real estate, both on the passive and active sides. We feature life-changing stories of today's real estate leaders that will help build your own roadmap to success. This is a show that will lead you to a diversified portfolio, a much bigger revenue, and a next-level venture that brings you a smooth cash flow. Let's get this episode started. Hi everyone, welcome to the Real Estate Private Equity Show. I'm your host, Ava Benasaki, and I'm joined as always by my co-host, August Biniaz. We're really excited today for our show, you guys. We have Paul Moore joining us. But before I get into who Paul is, if you could please like and subscribe, as it helps us to continue to build our channel and bring you guys great content, great expert speakers.
I'm definitely excited to have Paul on our show. He's a thought leader. He's an author. He's all over the place. He's connected to bigger pockets, and everybody knows how Goliath of a real estate investing platform they are, educational platform they are. And I can't wait to get a crash course on self-storage because it seems to be the new in and fun thing. You know, all the cool kids are doing self-storage. So we want to get a crash course today. So yeah, maybe you can tell our audience a little bit more about Paul, his background.
Yeah, guys, wait till you hear about Paul. Okay, here we go. Paul, after a stint at Ford Motor Company, Paul co-founded a staffing firm where he was 2X finalist for Michigan Entrepreneur of the Year. After selling to a publicly traded firm, Paul began investing in real estate. He launched multiple investment and development companies, appeared on HGTV, and completed over 100 commercial and residential investments and exits. He has contributed to Fox Business and the Real Estate Guys Radio and is a regular contributor to Bigger Pockets, producing live shows, recorded video, and blog content. Paul also co-hosted a wealth building podcast called How to Lose Money, and he's been featured on over 200 podcasts. Paul is the author of Storing Up for Profits, Capitalize on America's Obsession with Stuff by Investing in Self-Storage, which is Bigger Pockets Publishing 2021, and The Perfect Investment, Creating Enduring Wealth from the Historic Shift to Multifamily Housing. Paul is the founder and managing partner of Wellings Capital, a real estate private equity firm, and we're really excited because we believe this interview with Paul will bring value to both passive and active investors looking to learn more about self-storage investing. So welcome, Paul.
Welcome,
we're really
Paul.
excited to have you here.
Great to be here. It's such an honor. Thank you so much.
Honor is absolutely ours, and let's get started.
Maybe, Paul, you can just start off by telling us a bit about your background and then your start in real estate, please.
Yeah, so I told my wife, I promised her that I was going to stick with multifamily because I had jumped around. I was a certified shiny object chaser. Yeah. I thought about putting serial entrepreneur on my business card, and I was proud of that. Seriously? It was terrible. I thought I was a full-time investor. So I had sold my company in 1997, and I thought I was a full-time investor, but I was really not. I was a full-time speculator. And as a result, I lost a lot of money, and I made a lot of money, but it was inconsistent. I didn't like that. And so I was trying, as I flipped all those houses and flipped waterfront lots and did everything I did, I was trying to figure out how to get involved in commercial real estate. Well, I stumbled into it during the Bakken oil boom that happened. It was in Alberta, and it was all the way down through North Dakota. We actually invested in oil and gas in 2010, and we built a multifamily complex, and I loved multifamily. And so I decided to stay in multifamily. I wrote that humbly entitled book called The Perfect Investment. But the perfect investment's not perfect if you can't find deals that make financial sense. And though a lot of people are still finding good multifamily deals, our company wasn't doing it. Our acquisition pipeline was basically not finding the deals that we really needed, to safely make a profit. And so I was in my 50s, and I actually thought, this is starting to feel like speculating again. And so we decided to look for asset types outside of apartments, and we found mobile home parks and self-storage and other asset types that have a lot more meat on the bone, a lot more upside. And by investing in those, we have found a lot more profitability for our funds and for our investors.
Incredible. Great background. And now I want to get into the current high inflation environment that we find ourselves in. And I want to kind of explore the different asset classes within commercial real estate, because there's a spectrum of these different asset classes and them capturing inflation. So I make an example, for example, this spectrum starts with hospitality, where you can fight inflation because you can change your rates overnight. If you own a hotel, you can change the rates overnight. And then you've got multifamily, where you can change your rates annually, every term of the, as long as there's no rent control, like here in Vancouver. And then you have other asset classes, for example, industrial, which is a 10-year, in average, a 10-year contract that you're in. So it's very difficult to fight inflation. Talk to us about self-storage, and how does self-storage capture inflation and basically try to mitigate inflationary concerns?
August, I've been on a lot of podcasts, and no one has ever put it so well. That is really, seriously, very insightful. And I think it's really important to see the difference between these asset classes in an inflationary environment. And so self-storage, probably second to hospitality, captures inflation very, very well. Because I know a guy who does 20-year Amazon warehouse leases. I'm worried about the guy, because I don't, those leases are set up 20 years in advance, and I don't know how it's going to go for him in 7 or 8% inflation. But self-storage has month-to-month leases, and that's one of the beauties on multiple fronts of self-storage. And we're able to raise the rates every month if we wanted to. We probably wouldn't do that, but let me tell you a few things about self-storage. If you are renting an apartment for $2,000 a month and the landlord raises your rent 10%, you might leave rather than sign that paper and pay an extra $2,400 next year. But if you're renting a self-storage unit for $100 a month, you get a 10% increase. You might grumble, but you're probably not going to spend a weekend, rent a U-Haul, get your friends together to move your treasures down the street just to save, $10 a month. And that's one of the beauties of self-storage.
So it's basically that tenant retention has a much more likeliness because of the relativeness of the increase in rents doesn't really affect the tenant much. So that's beautiful. And I talk this a lot. I talk about this a lot, that we're in the business of increasing NOI, and a lot of people, feel like we're business. We're in real estate investing, but the mission here is to increase the NOI. And in a self-storage situation, that NOI can be increased nominally, and but in our books, that's tremendous.
Yeah, definitely.
It really is. It makes a huge difference, and I've got tons of examples we can talk about in that regard if you want.
Go ahead. Give us some more information there if you could.
Yeah. Well, so kind of going back to that comment. So I know a self-storage operator right up the road. I could be there in 6 minutes. And he said, "Hey, I've had this self-storage facility for 28 years. I've only raised rents 4 times." I'm like, seriously, you want to sell? But a lot of mom and pop operators, they don't have the desire or the knowledge or the resources to increase NOI, the net operating income, and to maximize the value of the facility. And so we can buy a facility from these mom and pop operators at a very fair price, but have a lot of upside. Some of them, for example, might say, "Hey, there's 6 acres out back. I have no use for it." Well, okay, great. We can put portable units on there. We can gravel or pave it and put boat and RV storage. We can maybe build more units on that 6 acres, and that's a great problem to have. Another example of a value add, there's so many low-cost value adds. One would be adding U-Haul. Now, U-Haul, they will work with private self-storage owners and operators to add U-Haul. You put a U-Haul truck out front, you stage it there, and you sign it in, sign it out, and you can make between $1,000 and $5,000 a month. Let's look at the math on that. So let's say you make $3,000 a month in commission from U-Haul. That's $36,000 a year. Now, the value formula in commercial real estate says that the value equals the net operating income divided by the cap rate. And so 36,000 a year in additional net operating income divided by, let's say, a 6% cap rate. And that's the capitalization rate. That's the general rate of return you would expect on this asset type in this location at this time. 6%, so 0.06. 36,000 by 0.06, that is $600,000 in additional value added to the facility. If you bought that facility for $2 million with, 800,000 down, you just got a 75% return on your equity in the value of that asset. That's very, very powerful. Other value adds would include filling 40 vacant units. Let's say it's $125 a unit. 12 months, that's $60,000 a year in extra income, but that's $1 million a year in extra value at 6% cap rate. Or raising the rent by 10%. That's, let's say that's $12.50 a month. That might not sound like much, but you multiply that over 500 units times 12 months, that's 75,000 in additional income, 1.25 million in additional value. Other examples would be, renting a billboard or a propane filling station or an ATM or even a cell tower lease.
Car wash.
Car wash. That would be perfect out front. Adding point of sale items like selling locks, boxes, tape, scissors, adding insurance and late fees. You can make $5 a month from insurance, tenant insurance, but you multiply that over 500 units times 12 months, that's 30,000 a year. That's enough to pay for an employee. And it's $500,000 in additional value created. So there's lots of ways to create value in self-storage.
That's incredible. And this is what's so powerful about, doing the numbers on commercial real estate. You take the income approach as opposed to the comparable approach. And this is one of the most exciting things for me to go over when showing to investors multifamily assets, because it's very relatable.
You showed $2 million in renovation equaling $10 million in force appreciation.
Isn't that amazing?
Blows their mind.
Mind.
And it's the seventh wonder of the world, or eighth.
I know, right?
It's right next to compounding interest.
Yes, there you got it. Paul, you know what? I wanted to discuss cap rates in self-storage. Cap rates are extremely important to real estate private equity firms as we are chasing yields for our investors. So how do self-storage cap rates compare with multifamily cap rates?
I wish I had a better answer, but I'll tell you that self-storage cap rates have, they used to be 8 to 10, even 12%. Now they're right neck and neck with multifamily in the 4 to 5 to 6% range, but generally about 5%. Now, here's where I'm going to say there's a big difference. 93% of multifamily assets over 50 units are owned by companies. And those companies have multiple properties and they generally know how to do the value adds. In other words, the value add is often wrung out of those large multifamily facilities or assets, I should say. But in self-storage, about 75% of the assets are owned by independent operators, and 2 out of every 3 of those are owned by single asset owners. And they often are, let's just be honest, mom and pops. And therefore, a 5% cap rate buying one of those assets that has all this intrinsic value built into it, all these opportunities for upgrades we just went over 3 minutes ago, that is a big difference from buying an optimized, already value-added multifamily in many cases.
I don't expect you to know the answer to this question, but the stats you gave, so 93% of multifamily properties over 50 units are managed by
companies with
companies that are
multiple
well established. Let's call them, they're professionally managed. But and then on the other numbers you mentioned, 75% of self-storage are managed by moms and pops, let's say, not professionally managed. Is there also a number of storage units that kind of triggers that 75%, or that's in total? Do you know that by any chance?
That's in total based on the number of facilities. There are 53,000 self-storage facilities in the US, and that's about the same as Subway, McDonald's, and Starbucks combined. And about 75% are owned by independent operators.
Got it. And the
Okay.
stats on multifamily is there's 44 million multifamily units in the US. Only 20 million of them are being managed professionally. So I guess that 24 million, many of those 5 units, 10 units are, fall into that 24 million. That's why it's at that.
Okay, I was actually what I meant to say was multifamily above 50 units.
Yeah, exactly. I got that. But I'm just saying that that's why there's probably quoting.
Oh, yeah, right. That's right.
Yep. Yeah. Now, going back to the last conversation we were having, as far as value add and this, the tremendous kind of ability to add value, is it fair to say that self-storage and the ability to be able to create value add, there are more creative ways to do so than in multifamily? Obviously, in multifamily, we see groups adding dog parks, what is it called, Amazon or
Amazon
storage, you hear or Wi-Fi. You do see some creative items where to in an attempt to increase NOI, adding washer dryers, depending on the class of the asset. But is it fair to say self-storage has more creative ways, more potential to increase the NOI because, you can be more creative?
August, when I first heard the term value add self-storage, I laughed because I thought, wait, when someone leaves, what do? You sweep it out and you put a new lock on and you start over. Where are the kitchens and countertops and lighting and flooring and dog parks and all the stuff we have with apartments? What I found was this list of about a dozen major value add strategies in self-storage. I don't think it's more than apartments, but what I think is this. I think apartments have largely been already done. In other words, the heavy lifting in, let's say, for example, 90% of large apartments have already been done, and it's really hard to get a nice list you can go in and do. But in self-storage, I think there are a lot more mom and pops that don't have a clue about these value adds.
Incredible. All right. Our next question here, we're going to talk about supply and demand. And a lot of time we see the graph with, multifamily, large multifamily developments, their applications with the city that track these applications. They can see about how much supply is coming down the pipe. And every time the market does really well, developers kind of start developing. Every time the market slows down, they slow down. We've seen that since 2008 financial crisis, where development reduced significantly, and it created a demand for apartment units. They say right now we're $6 million below the current demand that the US has. Now, are you noticing the same idea, same concept in self-storage, where ground up developers are coming in and building? And could the same fate that happens to multifamily, which sometimes is overdevelopment, do you see that taking place within the self-storage? Because self-storage, as far as the infrastructure, is much easier to put together than a multifamily. So could we say that overdevelopment or ground up developers are potentially could be the Achilles heel of value add self-storage groups?
Absolutely. It is the number one risk in self-storage. We invested in a Bradenton, Florida self-storage deal that was one of the two facilities, they were neighboring facilities, was brand new. And 2 new large national players popped up down the road. And these 2 national players were able to outmaneuver, outmanage, underprice us. And it took us about 3 years to get to stabilization, which is a 90% occupancy, where, if without them, it would have been much faster. And so it is a huge risk. I can drive you around Boise, Idaho, and show you that Boise, Idaho is extremely overbuilt, like literally 3x overbuilt for self-storage. But then I can take you to a suburb of Boise where there's a lot of population growth and it's underbuilt. And so my answer to your question is yes, that's a great risk. And also that if you can find certain pockets where it's still underbuilt, that is a great opportunity in self-storage. Nashville's the same. It's generally overbuilt, but there's a section south of Nashville that we visited. I think it was Belmont or Bellevue, and it was extremely underbuilt. For, the citizens didn't want a self-storage. The local planning and zoning kept self-storage out. So incredible opportunity if you can get in there.
For new construction, I guess they kept
Yeah,
them up.
that's right.
Already existing places were there, so it creates
Right.
opportunities. Amazing. So let's get
I
to.
wanted to talk, Paul, next kind of topic, the 7 paths to self-storage success. This is a instruction manual from your book. Can you talk to us and tell us about the 7 paths to self-storage investing?
Yeah, Ava. So, I actually was really frustrated for years. I was trying to figure out, how do I get involved in commercial real estate? And it seemed like the barriers were really high. Would I need millions in liquidity? Would I need tens of millions in net worth? How could I get the attention of a broker? All those questions, I didn't even know about the broker question until I tried to track down a broker to make an offer, made a full price offer on a piece of land in Houston, and they didn't even call me back because they didn't know who I was. And so those barriers to entry are very real. So I dedicated the last third of my book to try to figure out how to overcome the barriers to entry in commercial real estate in general, specifically in self-storage. So path number 1 is, I'll call it stair stepping. And that would be buying a very small facility, fixing it up, marketing it well, doing everything you would with a larger facility, and then selling it, raising the income and selling it for a profit, and then buying another larger one and doing the same thing, and just keep repeating that process. We know somebody who in Texas started with $1,000 investment. Now they have like an $18 million asset that they're sitting on because they stair stepped up for like 22 years. Path number 1, it would be stair stepping. Path number 2 would be being a capital raiser. The Securities and Exchange Commission looks really close at how you raise capital, and they don't like it if you're trying to raise capital on commission unless you're a licensed broker dealer. So the other alternative is being a general partner in the deal. So you need to be a general partner or a licensed broker dealer if you want to do this. Raising capital can be a great way into the business, because if you have a lot of contacts, if you have social media, if you have a podcast, if you have a lot of ways to raise money, you can raise money, bring it to an established general partner, and become a general partner in their deal, stay in the deal, and you can learn the business. Path number 3 would be similar, and it would be a deal finder. A deal finder is sort of similar to a real estate broker in that you're finding the deal. And instead of saying, hey, give me a commission, you're saying, hey, can I stay in the deal as a minority owner? And by staying in the deal as an owner, I get to sit in all the meetings. I get to meet the lender. I get to sign on the debt. I get to do all the different things that an owner would do, and hopefully learn the business in that way as a deal finder. The 4th path is not going to be taken by many, and that would be go big. That would be if you won a lot of money in the lottery, or if you made a lot of money in Bitcoin before it dropped, if you retired from the NFL, or if you inherited a lot of money and you just want to start out with a $10 million asset. Well, good. My recommendation is get a lot of training, get a great team around you, and be real careful. Path number 5 would be get a job. Now, most people are probably watching this trying to figure out how to get out of their job, not to get another job, but the opportunity in self-storage would be to become a property manager for self-storage, or an asset manager, or maybe working in a commercial brokerage that sells self-storage or other commercial assets, or becoming a mortgage lender for commercial real estate, specifically self-storage. Through this job, you get to make money, and you also get to learn the lingo. You get to meet the different players, and you might even meet your future business partner. So getting a job is a potential way to go. It's the 5th path. The 6th path is taking the passive path. The passive path would be something that you both and I are very familiar with, because a lot of investors, like the guy who called me an hour and a half ago, said, I really want to buy a self-storage facility. but I know I don't know how to do it. So maybe I should just invest in a syndication or a fund. And that's what our company does. We provide opportunities for people who love real estate, but they're not sure how to do it, to invest passively. They get a monthly check, they get the appreciation, and they don't have to quit their day job or stop enjoying their retirement. That's the sixth path. Is
One thing to add on this sixth path is that someone who's looking to become actively involved in a certain asset class, in a certain type of CREs, is great to start as a passive investor, see the journey, understand about the business model, but also learn about how the operator you've partnered with is doing their investor relations, communication, so you can learn from it. So it's a great way with a nominal amount of, whatever, 50K, 25K, 75K to get your foot into the door and learn about the business. Just want to add to that.
That's exactly right. And that's a great point, August. Path number 7 would be finding an unpaid mentor or a paid coach. So a lot of us know that in multifamily in particular now, but in other asset types as well, there are paid coaches where you can pay them anywhere from $10,000 to maybe $50,000, and they'll coach you on how you can build your own self-storage or other commercial real estate business. And one of the benefits of this is that you can go through the coaching program and then potentially partner with them, or potentially partner with somebody else in the class with you. Maybe they bring the cash, you bring the deal, the coach oversees the whole process, and you've got, you're launched. And so this is the path I took to get into commercial real estate. I actually was, after I did our first deal in North Dakota, I went and got a mentor to learn to do it right before I proceeded further.
Amazing.
Oh,
I
right
love
on.
that.
Yeah,
I love that.
Yeah, same. Thanks for sharing those.
You bet.
One more item that I see a potential for somebody being involved. I describe the commercial real estate space, or the real estate private equity space, as a pie, divided, the operational side of it, as a pie divided into 3 sections, one being the equity piece, one being the acquisition, finding the deal, physical due diligence, and what have you, and one piece of the pie being the operational side, value add, asset management. On that logic, on that pie that I'm describing, is it fair to say that if someone has construction background or asset management background, they could bring that sweat equity to the deal and add that value as an asset manager overseeing a property manager, overseeing contractors, overseeing a value add process?
I absolutely believe that. Yeah, we did I'm in a mastermind with 7 or 8 of the top multifamily guys in the US. And we've been toying around with what percentage is fair to give each party. And I think we all agreed that the asset manager, construction manager, that's probably the hardest piece. And we think that it deserves the biggest piece of the pie, in fact.
Great. I would love to have a conversation with you at some point about that.
Yeah.
Okay, absolutely. Amazing.
Okay, next question, Paul. We're gonna put you a little bit under the gun here. So get ready.
Yes.
If you had to choose the best city in 2023 to invest in self-storage, what would be your top pick?
And I know you got a dog in the race because you're an active investor and you have a portfolio all over the place. But keeping that aside from it, sometimes we have invested in different cities and different regions, but the data and the interest is obvious of where people are looking at, and where is our gut feeling as the best performer next year in 2023? What would be that for you in self-storage?
Yeah. So can I give a 2-part answer?
Absolutely.
All right. So I did a quick analysis for a Bigger Pockets article I was writing recently, and I came across, just for fun, I was checking out Boise, Idaho, which I mentioned earlier, Nashville, and Atlanta. And Atlanta was actually the 3-mile radius around the center of Atlanta was actually significantly underserved with self-storage. And so if I could find an empty Sears or Kmart or Toys R Us, or if I could find an empty warehouse, or if I could find the land, which would be hard, I would consider Atlanta as one of the great cities to build in, or to do a renovation project to take an old building and make it into a self-storage. Now, my second part of my answer would be Ishpeming, Michigan. What? Ishpeming, Michigan? Yeah, it's a town of 3,000. Our company invested in a huge self-storage facility in Ishpeming, Michigan, which everything in your brain probably says that's crazy. But we invested in a 1,500 unit self-storage there, 160,000 square feet. And it is going fantastic because it's a very undersupplied area. People are coming from a long way away to store there. And I really don't mean Ishpeming specifically, even though that is a true story. I mean, consider investing in small towns, because you're not going to be like that Bradenton, Florida deal where you got two competitors popping up next door. You're not going to be in a place where it's hard to get zoning. You're not going to have all the struggles you have in a big city, especially with competition. Small towns like Ishpeming and Beeville, Texas, where we invested, have proven their weight in gold, because Americans are addicted to stuff. And whether they're in a small town or a big city, self-storage can work really well.
And now
Oh,
with
right
how much
on.
free money has been out there, people have bought a lot of stuff over the last couple of
Yeah.
years. So
Oh,
there
yeah.
the need for self-storage, and then people are migrating. Really, American public, they're really the
It's
new
so true.
generations are becoming, they're becoming very mobile. They're becoming very, migratory.
Right.
A very brief question before getting to our last question, before the next segment of our show. Talk to us about a term of these projects. We're very familiar with multifamily value add, which is 3 to 7 years. That is somewhat changing. People are going to the fund model. They want to hold assets as close to 10 years to be a bit more risk averse for their investors. What is the industry standard term for a self-storage value add project?
Well, we're using the same Fannie Mae and Freddie Mac debt, and we're, talking to the same investors. So honestly, it's about the same. I mean, my company really tracks with Warren Buffett, who said my ideal holding time is forever. And so we're tracking toward the 10-year hold. But overall, I mean, a lot of these deals go really well in the 3 to 7 year range as well.
So you're similar to multifamily. You're opportunistic in about your exit. And
Yes.
perfect.
Right.
Last question before the next segment of our show. We want to talk about this concept of co-sponsorship. Obviously, you gave your 7 paths to be able to invest in commercial real estate and be involved in these syndicated investments. Some of them entail partnering with an operator. Briefly, does your firm partner with active operators as your boots on the ground in the assets that you acquire in self-storage?
Actually, it's the only way we do it. We decided years ago that we could not be an expert in 5 or 10 different fields, different asset classes, and we thought that our investors and us deserved the diversification that comes from a fund like that. So we decided to go ahead and be a third party to every deal. We don't own, we don't operate, we don't manage anything. We just find the very best of the best operators. Our goal is to, that 80-20 curve, our goal is to be in the top 20% of the top 20%, or the top 4% of the operators that are generating the top 80% of the top 80% of the results. And so that's the only way we do it.
Tremendous. And when you create these partnerships, is it fair to say, or is it likely that other groups and other individuals, you open the door for them to possibly partner with you, or you're very strict when it comes to yourselves as the private equity group and then your active operator as your boots on the ground, that type of partnership? Or is the door open for multiple co-sponsors to be involved?
So we spend a lot of our time. We had 3 or 4 meetings today alone with potential operators that we might want to invest with. And so we spend a lot of time getting to know those operators. We check out their track record, their team, their technology, their background, their criminal history, everything imaginable. We do due diligence on them. And so when we invest, we're choosing them. No one that I know of has ever come to us. We've just chosen, we went out and found them, and then we have decided who we wanted to invest with, and then we invest heavily with them. We might invest anywhere, up to, we invested up to, I think, 46 million with one operator in the last 3 years.
Tremendous, tremendous.
Yeah.
And that's kind of the reason I bring this up, because initially when we founded CPI Capital, our mandate was to acquire multifamily assets, in the US, in the Sunbelt states, while partnering with retail investors, both Canadian and US investors. But soon we realized that so much of our time and resources was being spent on cultivating and nurturing relationship with investors that we decided to we should contract out the operation side to an active operator, and we put our multifamily partners through the same process. But we did it out of a need, not a want. We did it because we needed to do that. We didn't have the infrastructure in place. But what happened eventually was that I realized that as we were making communications with these active operators across different regions in the US, it created a funnel for our deal flow, because each active operator is out there vetting and looking at hundreds of deals before they go into contract in one deal. And then we're sitting back and having all these different operators bring us deals, and we're cherry picking the best deal. So the business model itself ended up being a great model to follow. Is it fair to say you're seeing similar type of concept that I just explained?
Yeah, that's exactly right. I mean, we cherry pick some of the deals from some of the operators we work with, but some of them we're so confident in that we basically just invest in their entire portfolio. So anything they buy this year will be part of it.
Got it. And now the last comment to make here before we move on, CPI is in the process of making the transition to become the operator. So is there any plans for your group to make that transition, or if you guys have made the decision that your mandate is to allow the operation to be controlled by or handled by your operating partners?
I am too old.
Got it.
I'm just too old to start becoming an operator now. And I just don't think, Michael Phelps won 28 gold medals for the US in swimming. If he would have diversified out and tried to do shot put and javelin and running and all kinds of other things, I don't think we would have ever heard of him. And so I really love the idea of taking a small piece of a whole lot of different specialists. And that's what we do. And I look back over my 31 years as an entrepreneur and realize I was never a good operator. I was always better at, putting together deals, strategizing, raising capital, connecting groups together. So that's just what I do anyway.
Great advice. We really appreciate all the wisdom that you bestowed upon us. And we are certain that our audience will also have a lot of, take a lot of value away from all your information. Amazing. Now we're up to, on to the next segment of our show.
Yes, Paul, it's called the 10 Championship Rounds to Financial Freedom. So whatever comes top of mind, I'm going to go ahead and ask you the first question, and we're looking forward to kind of seeing the man that you are. So here we go.
Okay, I'm nervous.
All right, Paul, who is the most influential person in your life?
I'm going to have to say my dad. My dad was not an entrepreneur. He worked for a big company all of his life. But in 12 years of me playing football, he never missed not only a game, he never missed a practice. I mean, he took off early every day, even though he was an executive at this company. He was just a great man. And when I went to work for that company later as a summer hand in the factory, I found out that everybody, even including his enemies, on paper, actually loved and respected him.
That's beautiful.
Amazing.
Oh, very nice. All right, Paul, what is the number one book you'd recommend?
I'm going to go with Gary Keller and Jay Papasan's classic, The One Thing. Okay. I think it's so important to not chase shiny objects, which I did, and to learn to focus your attention and be an extreme specialist on one thing, like Michael Phelps.
All right. Okay, cool. I'll have to read that one, August.
Absolutely.
Okay, if you had the opportunity to travel back in time, what advice would you give your younger self?
I've thought about this quite a bit. And if I would have listened, which I don't know if I would have, I don't know if I'd even have gone to college. I guess I would have, but I would have jumped straight into commercial real estate day one. I have a lot of value from the years I spent in residential real estate, but honestly, if I would have known the power, like you said earlier, of forced appreciation and value add and, extracting intrinsic value, I would have never done anything else.
Right on, right on. Okay, Paul, what's the best investment you've ever made?
Best investment I ever made? In myself. Am I supposed to say that? Anyway, Seriously. Yeah, I mean, if I had to pick the very best deal, our company was the largest investor in a mobile home park in Louisville. It was acquired February 2020, right when COVID was hitting the headlines the same week. $7.1 million, half debt, half equity. The goal was to get it to a $13 or even $14 million value in 3 years. We were able, our operating partner, I should say, was able to turn those knobs right in the middle of COVID and got a $15 million offer and sold it for in 10 months for a 347% IRR.
Wow.
Amazing.
Congratulations on that. Okay.
Thank you. I mean, the cool thing is this operator's doing this over and over. That just happened to be a especially dramatic one because he sold it so quick.
Yeah.
Oh, wow. Right
It's the
on.
jockey, right? It's a really good jockey.
It's the jockey. That's right. I have an article about that.
Amazing.
Oh, nice. Okay, Paul, now what's the worst investment you've ever made and what lessons did you learn from it?
How many hours do you have?
Amazing.
No, I have several. I'm going to say we invested in a multifamily deal. This is the most painful one, I think, in Lexington, Kentucky. And our mentor said, there's so many good things about this asset, but it was built in 1962. They did wrought iron pipes. No, they didn't tell me that. But soon after that, I learned that there were wrought iron pipes, and sometimes they go bad. And so a year into owning this 125 unit, $8 million apartment, found out that some of the pipes were starting to fail. And we were terrified because the first one, we didn't handle it as well as we could have because it was kind of an emergency. But we spent $107,000 on the first one, and there were 18 other buildings. And so we were just very, very upset about this. And there were other property management issues. Lexington, Kentucky got stalled for some reason on rent increases right about that time in the teens. And so we ended up selling that even though we sold it for more than we paid for it, we actually took a slight loss on it. And it was really painful because we had 48 investors who really believed in us. And I will tell you what we did. We actually offered those investors, we said, as hard as this is to say to you, if you'll reinvest with us in this next fund, which would be self-storage and mobile home park fund, we promise you in writing that if you don't recoup not only your losses, but what you would have and what you expected to profit from that, we'll write a check to you personally. So what did we learn? I mean, I think listening to our mentor who hinted that the 1962 buildings could be a problem.
Okay, well, thanks for sharing that story. And that's really, really nice that they offered their investors.
That's the type of sponsor you want to partner with, right?
Exactly. Okay, Paul, next question. How much would you need in the bank to retire today? What's your number?
Well, I tried to retire kind of at 34 when I sold my company 25 years ago, and I was miserable. So I decided I never wanted to retire. However, if I did, I don't know, because I have a big goal, which if we might get into one of the other questions, I don't know, but I've got a really big goal. And that big goal is going to take millions of dollars a year alone to fulfill. And so aside from that big goal, I would say 2.5 million in the bank.
Okay, right on. I kind of want to know what the big goal is.
Okay.
You might ask in one of the other questions. I don't know. Do you have any questions about your big why?
Oh, no, we don't. So what's your big why?
Did you know, Ava, if you took not the average, the record profits of Apple, General Motors, Nike, and Starbucks, if you took the record profits, added that together, doubled that number, that's the approximate revenues generated by human trafficking every year. Okay. It's shocking. Wow. And it's happening right under our noses. And I'd like to believe if I was if I was an abolitionist, if I was alive in the 1800s, I'd have been an abolitionist fighting against slavery. And if I'd have been alive in the 1960s, or at least an adult, I would have been fighting for civil rights. Well, this is a civil right. This is slavery, and it's happening right under our noses. And I think that we are in a position where we can do something about it. And so my company, Wellings Capital, is trying to find and partner with the best, most effective agencies to fight this great evil and to free victims.
Incredible.
Wow, that's
Amazing.
amazing, Paul. Thank you for sharing that.
Yeah.
Oh, amazing. Okay, next question. If you could have dinner with someone dead or alive, who would it be?
I think it might be George Mueller.
Okay.
And George Mueller is somebody who spent a little time in Canada. George Mueller was a hellion in Germany in the early 1800s, and he had a radical life change. He went to England and he started opening up orphanages for orphans, and he eventually took care of 10,000 orphans. Now, here's the amazing part. He raised what we believe is about $250 million, maybe more in today's dollars. And he never asked anybody for a penny. He did it all by faith and belief and having this great big mission and believing that it would get funded if he just kept moving forward. And he did. And it's an amazing story. There's probably a dozen or two biographies about the guy out there, but he's largely forgotten. He lived through the entire century of the 1800s.
Oh, wow. Very cool. Okay, I'll have to look him up.
I want to extend our 10 questions to 20 to just keep
I know,
talking
just to keep
Paul,
talking
right?
to Paul. I'm learning a lot.
Guys, you're too nice.
Amazing. Okay, Paul, now this is going to be interesting. If you weren't doing what you're doing today, what would you be doing now?
Oh, wow. I love what I do. I love introducing people to commercial real estate, and I can't imagine doing anything else. But I guess going back to my previous comments, I would be involved in trying to rescue slaves out of human trafficking and try to help them connect to rehabilitation.
Amazing.
Just quickly on that, is human trafficking mainly focused on when people try to come to certain places in Europe from Africa and the Middle East and to America from South and Central America for better lives, but just in the process they happen to owe some money and go into this life? Is that the primary reason for human trafficking?
I of all the time I've spent in this arena, I don't know the answer to your question. That is certainly a big factor. I know in India, people are, they're lured away from these villages unknowingly and told that they could get great jobs in, Delhi or, some other big city in India. And then they find out when they get there, they're trapped and they're enslaved. This is happening, in the United States. It's happening all around the world. One of the best ways to fight it is to actually pass laws to make it a very, very serious criminal offense to hire a prostitute. And I think, from what I heard, Canada took some really good steps in that regard at one time in the last 3 or 4 years.
Well, prostitution in Canada is actually legal. It's living off the avails of prostitution, which is a criminal code offense. But Canada is very open-minded on that concept of that it is a woman's right if they wish to.
Yeah, the problem is, I don't mean to get too opinionated here, but the problem with that is if you talk to and really get to the bottom of the story, almost all those people who the women's right, most of them were enslaved or trapped or something horrible happened in their childhood, and they don't think they can do any better than that. But again, what I was referring to is there's an organization called Exodus Cry. ExodusCry.com. They have done a great job explaining all the evils of this industry. And they told me, their founder told me that they had showed that film to some lawmakers in Canada who were about to make a certain law, and they went the complete opposite direction after seeing the film. I don't know exactly what was the law. I should find out.
Yeah, it was recently passed by the Supreme Court, which became actual case law to be followed. Great. So we answered that question.
Okay,
Next
I'm
question.
excited for this one.
This
Paul.
is a great question to ask an author and an academic. So
yeah, definitely. Okay, ready? Book smarts or street smarts?
Oh, definitely street smarts.
Nice. All right. Last question. Okay. If you had $1 million cash and you had to make one investment today, what would it be?
And I'm going to reemphasize on this question because it's $1 million cash, so it's liquid. You can make only one investment and you have to do it today. Well, today it's the markets are closed, what have you, if that was your decision, somehow market related. But let's say in the next 24 hours, you have to deploy it. What would you do?
Yeah, I mean, so I don't mean to sound like I would invest with my own company, but I mean, I really would. And I've proven that over and over. I have been investing every chance I get with our own company. However, if I had to pick one of our operators, it's an operator in Nevada called Crystal View Capital. And they do an incredible job of finding these off-market, undervalued, intrinsic value laden deals in self-storage and mobile home parks. They have just incredible job of doing this. And they're, you know, those are the examples I've even used on this podcast in Ishpeming, Michigan, Beeville, Texas, Louisville. I mean, they just do a great job extracting value and providing returns for their investors. I would definitely do commercial real estate. And like I said, it would be us, or if not us, them.
Let's give some props to the acquisition director of Crystal View Capital because we know he or she is hard at work.
Yes.
Yeah, that is it. That's the key.
Awesome, Paul. Last question. What's the best way that people can reach you, please?
Yeah, they can pick up my book, Storing Up Profits, on Amazon or Bigger Pockets, and they can reach out to me. I've got some wonderful special reports on how to get involved in commercial real estate and self-storage and mobile home parks. You can go there to our website, Wellings Capital. That's WELLINGS, wellingscapital.com.
Wonderful.
Amazing.
Thank you so much.
And don't leave yet, Paul. We're going to have a quick chat with you, but really appreciate you being here today again. And thank you.
Thank you so much, Paul.
Thank you. It was a great honor to be here. Thank you.
Thank you for joining us for this episode. We hope this conversation enlightened you on how to win big in this highly profitable and risk-averse space. Get on your feet and embrace this world that offers so many opportunities just waiting for you out there. Continue your journey to becoming a savvy real estate expert by subscribing to the show at cpicapital.ca. Don't forget to leave a positive rating and share with your friends. See you on the next one.